You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley.
Hi, Giles.
Hi, Bill. What have you got for us this week?
Well, I only got a couple this week, Giles. I said earlier that I was going to look at the dollar index, and just show you how that is deteriorating against all currencies, and that is the problem. And looking at the chart from there, we've got a nice green bar sandwiched between two bars, red sandwiched between green, sort of green sandwiched between red. It's gone wrong. It went wrong in May, just when everything went up, and it's so typical that the largest rise in crude in a month since 1999 coincides with the slippage of the dollar. And also silver surged by 26% in May, which is its strongest performance for 22 years. Gold bullion advanced by 10.2% and platinum by 8.2%. I think it's all down to the dollar, or partly towards it. I think this is what we're seeing, and this will explain. This chart here should explain it all. At the top of the chart, I've got a multi-frame inverse Fisher transform of the RSI, which is basically normalized RSI on a weekly basis, and when that goes through zero, from positive to minus to negative, that suggests a downward swing, and when it goes from minus to positive, then there's a green line. So hence, that's why the green bar at the bottom is made up of that. And you can see from last August up to May time, broadly it coincides with the 200-day moving average, the big thick red line at the bottom of the chart there, underlying the US dollar index. So that sort of supports to the notion it's all going up, it's okay, and that is until May time, and it all goes wrong, and that's really triggered the commodities surge, I think. And this is what we're seeing. The weakness of the dollar is propelling the commodities.
So it's dollar weakness rather than commodity strength. Is that what you're saying?
I think so. I think there's a big mix of this, Charles. I think this is a big component. I think so, and this is the waters are muddied by how much growth there is in restocking in China, or we don't know. I mean, sort of until we get further indications of what's going on there. We know the property market's going on there, going quite nicely, and certainly the property market picking up there, unlike here, although we had a blip upwards last month, and I think it's a blip because I think the downward trend is still in place here. Then I think the stock market's probably going to go higher there. It's the big problem with us is the deleveraging of this of assets here. We've got a big major problem here, and because we're so trapped housebound in this continent, in this country. So we're sort of basically basking in recovery, but I don't think it's going. I think it's going to be short-lived because of the housing problem. And the assets, basically, if housing prices don't go up, then the feel-good factor, the spend factor, doesn't come through. And while houses are in a downward spin, I think with unemployment rising, I think we're seeing a backdrop of partial economic recovery with a fallback later on in the year in the UK. That's what I think here. I don't see it sustainable unless we get house prices rising here. So this is one part of the problem.
What do you think the likelihood is of that?
I think while house prices have never risen consistently, while unemployment's been rising. So and we've got unemployment numbers coming from America this Friday. Should be interesting if we're going to hit the 9.1, 9.2 level there this week, and that's pretty grim. Whether that changes or not, we'll see. But sentiment, I'm expecting also the Dow to fall back in the next 3 to 4 weeks. So I think the cycle of the Dow moving up is going to come to an end. It may coincide with some dollar strength here, but I think the dollar's going to weaken still, and I think the housing market is going to weaken still, and I think the rally is going to come to an end in 3 to 4 weeks' time.
Why do you think 3 to 4 weeks?
Well, because I think it's sort of like there's been a sort of 17-week cycle on the markets. It's going back to about July last year, and I will look at this next week, and it's an average of 17 weeks, and we're in week 13 or 14 at the moment, and just on that cycle, I think we're there. The key level on the Dow is going to be the 20-day moving average. When that breaks down, I think the market will come off, and it'll be very interesting to see if that's held. And as I say, I would like to see that next week when we get nearer to the turning point to see if that's going to be the case. But I expect that to cool off. And generally, this summer, I think we've had too much of a run already, and would expect it to cool off.
Okay, Bill. Now your next selection.
Yep.
is POG.Ping. What's that?
Well, this is Peter Hambro and Hambro Mining, and why I like this one, although it's the second largest gold miner in Russia, and what I've done here is done a comparison here against the gold price. Now, if all is going well with this company, then something's wrong, because it should be higher. Either there's something wrong with the perception of risk involved there, which might be the case being Russian. The Russian market is one of the best performing markets this year, but it's still well down on the year on year from last year to this year. But it's sort of so far this year it's an enormous rise in the Russian market. So is this too volatile? Is this too risky? This thing? But you can see back in May, June, July last year, it was running at parity with the gold price, or with gold, I should say. With the dollar strength last July and oil prices surging high, that made profitability very suspect in a lot of mining companies, and we saw the sell-off coupled with a slowdown perception of, and that sort of ended up in wild swings in October, November, and a steady recovery from December onwards, as you can see by the trend line there. But it's just, well, I like this one. It's just very close to its 200-day moving average, which is plotted on the chart there, the line, big red line going across the chart. It's just sort of, that's not too high. It's just showing good strength. And as I said, it's 60% underperformed the gold price. Well, even if Russia is risky, I still think there's worthy of a third, and I think gold's going to go higher on the dollar weakness. I think that's going to continue. I expect gold to go to 12 to 1300. Without too much problem, give or take a couple of hundred. I think it's maybe even higher, and that's possibly by the year end, early next year, sort of thing. And that's what I'm seeing. And I think this has got to be a pick if one wants to get involved there. Of course, it's a bit riskier because it's involved with the Russian side of things, and as we've seen with all sorts of goings-on and shenanigans with other companies, that it's no clear run as to what was going to go on out there. But it's worthy of consideration for those who want to take the risk.
Bill, thank you very much for that. We will chat again next week. And in the meantime, watch the markets, which have been very exciting so far.
Well, they have been, Giles. That's right. Yes, we're looking forward to seeing what's going on. Yeah, I mean, it's sort of still the UK market and the US, the two main markets, which haven't actually hit new highs yet this year since Trump sort of post January, which is quite interesting. We've got some way to go yet, but very, very interesting.
Great stuff, Bill. Thank you very much.
Thanks, Charles.